Zomato is caught in the eye of the storm. The stock, I mean, not the app. I use the app fairly regularly, so no complaints there. But the stock price certainly has been caught in the eye of a storm. And there are equal arguments around the pulls and pressures. Now, most brokerages, so we looked at the Bloomberg terminal, 14 out of the 18 brokers still have a buy call on Zomato. And most of them actually had a buy call even if the stock price was 60, 75, 90, maybe even 100 rupees a share. So what does an average retail shareholder do about Zomato? Well, the arguments are compelling on both sides. Let me give you. First, I start off with what set the cat amongst the pigeons according to me. The global CEO of Shopify mentioned yesterday in an internal memo that they have to lay off employees because consumer behavior is returning to the pre-pandemic behavior pattern, which is that consumers are returning to the store, the physical store, presumably physical restaurants as well. And yes, you and probably everybody else in my office are testimony to that. So that is part one. Remember, Ashwath Damodaran in 2021 had spoken about the valuation argument as well, wherein he had said that for Zomato to reach or justify the valuation of 120 or 130 rupees per share, as the case may be, it needed to show bigger business aspirations in not just food delivery, but a bunch of others. Now that the stock price is 41, it'll be interesting to see what are the bull versus the bear argument. The bull argument, as is the case of Credit Suisse, is that the existing core customers will drive the food business. The next phase of growth will be driven by higher ordering frequency. The industry structure, by that I'm presuming that they are saying the duopoly structure, will improve profitability dynamics, and they estimate that the food delivery EBITDA will turn positive by FY25. Will all of these happen? Remains to be seen, and which is where the valuation argument also comes into play as to how do you value Zomato. I spoke to at least 4 heads of research. I'll not name them, but the argument around whether DCF, which is the valuation methodology used by Credit Suisse, is the right method or no, is a forever argument, because a lot of people say that in a DCF you can value a company value a Zomato anywhere between 40 rupees to 140 rupees depending on the assumptions that you make. So people say use price to sales, but even in that case, how do you presume that the sales numbers of Zomato will keep on going up or keep on having a particular trend for n number of years? So all arguments are debatable. If you believe in the price to sales argument, then it's trading at about 6 times FY23, which a few people who believe in the price to sales argument say is a touch too expensive as well. So is Zomato really overvalued? Remains to be seen. Credit Suisse has a price target of 90. They came out of the report today. Jefferies has a price target of 100. They came out of the report yesterday. And a bunch of others still have a bullish argument on Zomato. Remains to be seen. To my mind, the key risks to Zomato, and I'll end this piece with that, is that even if you value, whichever way you value, let's say you assume the DCF value, which takes in a price target of 90 rupees or 100 rupees, the key risks are entry of other large players, a rise in interest rates, which is a big risk, and India's very own ONDC. If ONDC picks up steam, then a lot of people are saying that all bets on Zomato and some others are off the table. You take your pick.